Good morning. I'd like to go over one exercise in which we do journal entries using the periodic inventory system. Although this is very rare and uncommon in the real world today, almost every firm uses the perpetual inventory system. It's always good to know the other system simply because it gives you a better understanding of the perpetual inventory system. So let me try and do a quick screen share over here with you. And we'll be working on exercise 8-15 from our textbook. It's 5 transactions, and we'll see how to do each of these using the periodic inventory system in the books of the buyer. So again, it's the journal, so we have the columns for date, account name, debit, and credit. So let's start with the first transaction. The first transaction on April 5th, we purchased merchandise from Buck Company for $27,000. The terms are 210 net 30. Now, if we were using the perpetual inventory system, our journal entry would be inventory debit, accounts payable credit. However, we are not going to use the inventory account name as yet. We do that only at the end of the year or end of the period when you're doing closing entries. So I do know I owe money. So accounts payable is credited. That part doesn't change. The outside party doesn't care what we do internally in our books. They know that I owe them $27,000, which means I have to write accounts payable credit $27,000. The question is, what account do I debit? In the periodic system, I debit the account called purchase. Purchase debit, accounts payable credit. Purchase is really only a temporary account that at the end of the period, I'm going to close it out to inventory and cost of goods sold. We'll see how those calculations are done subsequently. For now, I just record it as a purchase. On the 6th, I paid freight of $1,200 for the merchandise that I purchased. So I have another journal entry over here. April 6th, I paid money, so cash is credit. Again, outside party doesn't care what I do. They need the cash. I make the payment, they got the cash, so cash is credit for me. For the other party, cash will be debit. Again, what would I debit here? Perpetual inventory, I would have debited inventory. But here, I'm going to debit another account name called freight in. I'm keeping a track of each of these separately. Anytime I make a purchase, anytime I pay for freight, all of those are going into separate accounts. On the third, in the third transaction, on the 7th of April, I purchased equipment on account for $30,000. This has nothing to do with purchase of inventory. So this journal entry is fairly straightforward. We have equipment debit, accounts payable credit for $30,000. Instead of accounts payable, we can also put notes payable over here. Now the fourth transaction does have to do with purchases. We returned some of the merchandise that I purchased on the 5th. $3,600 worth of merchandise has been returned. Now, I have my journal entry on the 8th. If I return, I'm going to pay that much less, so accounts payable has to be debited. That part is the same as in the perpetual. I'm going to credit a different account name than I did in the perpetual inventory system. The account name is called Purchase, Return, and Allowance. It's a contra account to purchase, which means I need to subtract it from purchase in the end to find out what my net purchases are. Finally, on the 15th, I paid the amount due to Buck Company in full. So once again, let's try and identify how much I owed. The first transaction, I said $27,000 accounts payable debit. And then here, $3,600. Here accounts payable was credited $27,000. Here accounts payable is debited $3,600. So the difference between those two numbers is what I owe. We're not talking about this accounts payable for the equipment. That's with a different vendor. We're talking about with Buck Company. So I'm making my payment. So on April 15th, I'm going to do my journal entry. Accounts payable is going to be debited. And the amount I know is $23,400. That's $27,000 minus $3,600. Okay. This entire amount was not paid because it was paid within 10 days. I'm getting a 2% discount. So cash payment is going to be 98% of this amount. So let's do these two numbers over here first. I get a 2% discount off the amount that I owed. 98% is what I actually paid. So this 2% discount, what account should I credit? Again, I'm going to use a contra purchase account, and that's called purchase discount. So your purchases, less your purchase return and allowance, less your purchase discount gives you net purchase. So as you would notice in all of these journal entries, I did not debit or credit inventory account. That's going to happen only when I do my closing entries. Let's look at the last part. They say, let's assume that the payment was made in full on the last day that I was allowed to make the payment, which means I didn't make use of the discount. Again, how much was owed? 23,400. So accounts payable debit, 23,400, and the full amount was paid. So this is easy. Cash credit, 23,400. So this is similar to what you had done in the perpetual system. If the full amount is paid, we don't need to worry about the discount amount at all. Well, we do need to worry about it in that we lost out on the discount. But as far as the journal entry is concerned, we're not going to worry about it. So once again, in the periodic system, as you look at your journal entries, inventory is not debited or credited. We have these different account names: purchase, freight in, purchase return and allowance, and purchase discount. The concept is the same, but how I do the accounting is going to be a little different. Once again, it's very rare to see companies using the periodic inventory system. Everyone uses the perpetual system these days, but once again, it's good to know how this is done. So this concludes chapter 5, and we will move on to the next chapter shortly.